In the discipline of risk management, there is a dangerous phenomenon known as the false sense of security. It occurs when an individual follows a legacy playbook, assuming that historical parameters still apply to a transformed environment. For decades, the 3, 2, 6-month emergency fund was the gold standard of personal finance, a rule of thumb designed for a world of predictable job cycles and linear inflation. However, as we navigate the economic landscape of 2026, this rule has become a mathematical relic. It is no longer a safety net. It is a structural vulnerability. To understand why, we must apply the normal accident theory. This mental model suggests that in complex, tightly coupled systems, multiple small failures don't just add up, they interact in ways that cause a catastrophic system-wide collapse. In the 2010s, an emergency was often an isolated event, a car repair or a brief period of unemployment. In 2026, emergencies have become coupled. A specialized industry contraction leads to a 7-month job search, which occurs simultaneously with a surge in tech-dependent repair costs and rising premiums. As a value investor, I view an emergency fund not as dead cash, but as a hedge against forced liquidations. If your safety net is too thin, a single 100-year storm in your personal life forces you to sell your compounding assets at the worst possible time. Most people aren't financially prepared. They are merely fragile with a small cushion. They have optimized for growth while ignoring the asymmetric risk of a total system failure. In this analysis, we will strip away the outdated tropes and recalculate what it actually costs to maintain your rationality when the world around you is in chaos. Real security in 2026 requires a deeper margin of safety than your parents ever imagined. In the discipline of structural engineering, a progressive collapse occurs when a single failure in a minor component leads to the failure of other components, eventually bringing down the entire building. In finance, Charlie Munger described this as the Lollapalooza Effect, a convergence of multiple psychological or economic forces acting in the same direction to produce a massive, non-linear result. The traditional 3-month emergency fund was designed for isolated failures. But in 2026, failures are almost always cascading. Consider the modern professional. A job loss in a specialized sector during an industry contraction is not a 90-day vacation. It is a 6 to 8-month strategic pivot. Because 2026 industries are highly automated and specialized, the friction of finding a comparable salary has increased. While you are navigating this extended search, the second-order effects begin. Your 2026 electric vehicle, essentially a high-performance computer on wheels, suffers a sensor failure. This is no longer a $200 mechanical fix. It is a $3,000 proprietary software and hardware calibration. This is where the geometry of failure becomes lethal. The stress of the job search and the financial strain leads to a stress-induced health event. Even with insurance, the deductibles and out-of-pocket maximums in 2026 can instantly claim $5,000 of your liquidity. The traditional model assumes these events are independent variables. Logic tells us they are positively correlated. Financial stress creates health risks. Health risks impair job performance. Job loss removes the shield of employer-provided benefits. As an analyst, I look for the mean time to recovery. If the average recovery time for a professional crisis is now 7 months, a 6-month fund is mathematically destined to fail. You run out of oxygen exactly 30 feet from the surface. This is why your emergency fund feels smaller than it used to. It's not just inflation, it's the complexity of the repair. In 2026, fixing a broken life is fundamentally more expensive than it was 20 years ago. You aren't just saving for rainy days. You are saving for a Lollapalooza of systemic friction. If your fund doesn't account for the cluster effect of modern crises, you are operating with a negative margin of safety. In the discipline of macroeconomics, there is a concept known as hedonic adjustment. The idea that a product's value increases as its quality improves, even if the price rises. While this helps economists calculate core inflation, it is a disaster for your emergency fund. In 2026, we are witnessing a massive disconnect between the interest earned in a high-yield savings account and the actual cost of survival services. This is the silent erosion of your margin of safety. While your savings account might be yielding a nominal 4%, the specific emergency economy healthcare, high-tech automotive repair, and specialized legal or relocation services is inflating at 8% to 12% annually. This is a negative real yield. If your emergency fund sits for 3 years before you need it, you haven't just lost the opportunity cost of the stock market. You have lost the literal ability to fix the problem you saved for. The $1,500 that could replace a transmission in 2020 only covers the diagnostic fee and a software patch in 2026. To understand this, we must use the mental model of relative value. Wealth is not a static number. it is the ability to command resources. When inflation runs hot in the service sector, your 6 months of expenses calculation, based on last year's prices, becomes a 4-month fund by the time the crisis hits. Most people calculate their needs based on trailing data, but emergencies occur in future prices. You are effectively shorting the cost of your own survival. Furthermore, we must address lifestyle inertia. Traditional advice assumes that when an emergency hits, you will instantly cut back to a subsistence level. In reality, the friction of reducing your burn rate is high. Your rent is fixed, your insurance is non-negotiable, and your professional network requires you to maintain a certain baseline of operations to find a new job. As an analyst, I view a stagnant emergency fund as a depreciating asset. If you aren't stress testing your fund against the rising costs of specialized labor and high-tech components, you are living with a diluted hedge. In 2026, the cost of being unlucky has risen faster than the cost of being comfortable. To maintain a true margin of safety, your fund must grow not just to match the general CPI, but to match the specific inflation of crisis recovery. In the discipline of finance, an option is the right, but not the obligation, to take an action at a specific price. Most people view their emergency fund as dead money because it isn't earning an 8% market return. But as a rational analyst, I categorize a robust 1-2 month emergency fund as a strategic reserve that provides you with optionality. In a crisis, the most expensive thing you can lose is not your car or your house, it is your agency. When you have only 3 months of expenses, you are a distressed seller of your labor. If you lose your job in month 1, by month 2, the time decay of your savings begins to dictate your decisions. You are forced to accept the first job offer that comes along, even if it's a 20% pay cut or a toxic environment. This is a suboptimal allocation of your human capital. You have traded your long-term earning potential for short-term survival. However, 12 months of liquidity changes the power dynamics. It gives you the option to say no. It allows you to wait for the right role that fits your circle of competence, rather than the first role that pays the rent. In 2026, the job market is winner take all. The difference between a good role and a desperation role can be hundreds of thousands of dollars over a decade. Your emergency fund is the premium you pay to keep your career trajectory on an upward curve. We must also analyze the psychology of risk aversion. When your margin of safety is thin, your cortisol levels rise, clouding your rational judgment. You become risk-averse in your investments and fear-based in your professional moves. You stop taking the calculated risks that lead to high returns, like starting a side venture or pitching a bold idea, because you can't afford to fail. A 1-2 month fund is a psychological hedge. It lowers your cost of failure, which paradoxically increases your probability of success. Finally, consider the forced liquidation risk. If a 2026 market downturn coincides with your personal emergency and your fund is too small, you are forced to sell your stock portfolio at the bottom of the cycle. You are turning a paper loss into a permanent loss of capital. By holding a larger cash reserve, you protect your compounding engine. You aren't just saving for a rainy day. You are ensuring your entire investment thesis. In the 2026 economy, liquidity is the ultimate moat. It is the only asset that allows you to remain rational when the market and your life becomes irrational. In the world of institutional finance, a stress test is a simulation designed to determine the ability of a financial institution to deal with an economic crisis. Banks don't just ask if they have enough cash for a normal month. They ask if they have enough for a liquidity crunch where every variable goes wrong simultaneously. In 2026, you must become the chief risk officer of your own life. The 3-2-6 month rule is a static number. A stress test is a dynamic analysis. To begin, we must identify your specific risk factors. The average person does not exist. If you are a specialized software engineer in an AI-driven economy, your mean time to reemployment is structurally different than a healthcare professional. If you own a home built in the 1990s, your maintenance tail risk is higher than a renter. We must calculate your emergency fund based on your burn rate under duress, not your budget on a good day. Consider the correlation of risks. In 2026, economic downturns are often industry-specific. If your sector contracts, your home value in that same region may stagnate, and your ability to access credit may tighten. This is a liquidity trap. Your stress test must assume that your safety valves, like a home equity line of credit or selling stocks, will be unavailable or extremely expensive exactly when you need them. We must also factor in dependent fragility. If you are the sole breadwinner or have aging parents and young children, your margin of safety must be doubled. In engineering, we call this a redundant system. If one engine fails, the plane must still fly. Your 1-2 month baseline is the first engine. The additional buffer months for your specific life variables, home ownership, plus 3 months, dependence plus 3 months, or specialized industry plus 3 months are your redundant engines. As an analyst, I look for the point of ruin. This is the moment where your net worth goes negative and you are forced into high-interest debt. Most people's point of ruin is much closer than they realize. By stress testing your balance sheet today, you identify the structural cracks before the storm hits. You aren't being pessimistic, you are being statistically rational. You are ensuring that your compounding engine can survive the worst-case scenario so that you are still in the game when the best-case scenario eventually arrives. In the discipline of systems thinking, we look at the flows and buffers of a system. For a traditionally employed person, the flow is relatively constant. For the freelancer, contractor, or business owner in 2026, the flow is stochastic, it is random and unpredictable. When your income is volatile, the buffer, your emergency fund, must be significantly larger to prevent the entire system from seizing up during a dry spell. The traditional 6-month advice is a linear solution to a non-linear problem. For a self-employed professional, an emergency is rarely just a personal crisis. It is often a correlated business crisis. When the market shifts, your lead generation dries up at the same time your equipment needs a high-tech upgrade. In 2026, freelancers don't have the safety valve of unemployment insurance or corporate severance. You are the insurer, the investor, and the employee. As an analyst, I propose a 2-4-month mandate for the self-employed. This sounds extreme to the first-order thinker, but the second-order logic is sound. 12 months are for your personal survival, and the additional 12 months are for your operational continuity. This second year of cash acts as working capital. It allows you to invest in marketing, pivot your skill set, or upgrade your technology during a downturn when your competitors are forced to shut down. You are using your buffer to survive the industry shakeout. We must also account for taxation and compliance risk. In a volatile income model, your tax liability in April might not match your cash flow in April. A thin emergency fund creates a liquidity mismatch that can lead to predatory penalties from the state, a form of systemic friction that compounds your losses. By holding 24 months of expenses, you decouple your creative and professional decisions from your immediate survival needs. You stop taking low-value gigs out of desperation, which protects your brand equity and long-term pricing power. You are effectively overcapitalizing your personal business to ensure that you are never a weak hand in the marketplace. In the 2026 economy, the self-employed individual with a 2-year cash mode is not just safe, they are dominant. They have the staying power that outlasts any market cycle. In the discipline of logic, the inversion principle popularized by Carl Jacobi and championed by Charlie Munger suggests that many hard problems are best solved when they are addressed backward. Instead of asking, how can I maximize my returns? The rational actor asks, what would guarantee my financial ruin, and how do I avoid it? In the volatile landscape of 2026, the answer is clear: forced liquidation and decision-making under duress. A massive emergency fund is not merely a savings account, it is a psychological fortress. When your margin of safety is measured in years rather than months, you possess a level of cognitive freedom that cannot be quantified on a spreadsheet. You gain the ability to remain stoic when the market and the world becomes hysterical, while others are forced to sell their compounding assets at the bottom of a cycle to cover a 2026 scale crisis. You are positioned to be a liquidity provider. You can hold, you can wait, you can even pivot. We must conclude that in 2026, the 3-2-6-month rule is an artifact of a more stable era. Real security is found in redundancy. By treating your emergency fund as a strategic asset class, you decouple your survival from the entropy of the machine. You are no longer a victim of economic cycles. You are an observer of them. The bank balance is just a number, but the autonomy it buys is the ultimate luxury. You aren't missing out on a few percentage points of market growth. You are buying the right to own your time, your health, and your rational mind. In the end, wealth is not what you spend, it is the quiet confidence of knowing that regardless of the storm, your structural integrity remains intact.